Hey everyone, thanks for joining us again. Today we're talking about markets, instruments, data, and the technical analyst. So this is a really nice set of chapters that we're going to cover all the way through equities, FX, futures, options, etc. It replaces some old content that used to be in the curriculum. So this is brand new for 2019. It replaces chapters which were essentially the same content, but they were specific to Bloomberg, whereas now the chapters are more generic. And so, you know, there's a lot of good material and a lot better written as well. So we're going to run through them. We're going to run through all of them just in separate little short sections so that the videos don't get too long, and then see how we go. One thing to note is that the way the exams work, there is this huge bank of questions, and the CMTA says to Prometric, we need to have 15 questions on theory and markets or something like that. And so Prometric just randomly picks out all of these questions. The thing that I'm concerned about when we have changes in curriculum like this is that some of the questions that you may be faced with, I should say, could still be from the old curriculum, you know, and especially when you've got something like this, where we've got old curriculum and new curriculum, which is very, very similar. It may be that you're going to get a question on, let's say, bills. You know, in the new curriculum just talks about bonds, doesn't really mention bills at all. So as we go through the material where there's things that I've seen before and I've seen questions in practice exams and things, I'll just highlight them and just keep them locked away in your mind that, you know, you could be faced with questions like that. In the Optuma practice exams, we're going to keep some of those types of questions in maybe a fourth exam or something like that, just so that if that happens, you're not taken by surprise. Of course, if that happened, technically that wouldn't be right. And you could argue it, but why bother? Why not just learn it and then get the pass, get onto CMT2 so you don't waste time and energy on that. So we'll take care of that as we go. So obviously there's 4 asset classes that we're dealing with. And out of those 4 asset classes, there's 5 tradable instruments. Now, not all of the tradable instruments are relevant to all of the asset classes. So, you know, we'll cover that and then describe data handling techniques that technical analysts should be aware of. A subject near and dear to my heart because we wrestle with data all the time. So it's a fun thing. So there are many markets where technical analysts can be trading. You know, essentially, so long as it's a fungible market, with meaning free of manipulation and things like that, and that's an interesting idea in itself. But if it's fungible and, you know, it's liquid enough, then yeah, we can trade, and there's got to be obviously a lot of activity. It's really hard to trade when you're wanting to sell and there's no buyers. So we need it active, we need it liquid, you know, they're the 2 things. Obviously that hits one of the learning objectives as well, so make sure you remember that. Again, fungible was a term that was used in the previous curriculum, so do make sure that you keep that in mind as well, that the markets have to be fungible in case something like that comes up. 4 types of asset classes: stocks, bonds, currencies, and commodities are the 4 types that we can trade in. And then there's 5 types of instruments: cash or spot. It's a little bit interesting because the text talks about spot here as the cash market, and I know that I've heard that many times. I've also heard the spot talked about in futures as the continuous front month contract. And so I think that definition is a little bit grey. So just be careful of that if you get a question with spot being mentioned in there, that you really think clearly about what that could be. Futures, options, indexes, and exchange traded products. We'll talk a lot more about all of those. All 4 of the asset types have all 5 of the tradable instruments available, but not all actively traded. You know, I haven't seen much in the way of options on ETFs and things like that. But, you know, they could be there. You know, at the end of the day, even though it may not be exchange tradable, there are always the possibility of selling assets by options as a contract between two parties. So those things are there. All right, so what we have here is a table which is where we as technical analysts focus our time. So, for instance, if we take the stocks row here, we obviously do our technical analysis on the underlying stocks. We don't ever, as much as we can trade options on stocks, we don't do technical analysis on the price of options. Look at options chains and we look at the volatility that comes out of options, but we don't do our technical analysis on that. We really are buying an option based on our belief of where the cash is going to go. We spend our time on stock indexes. We look at those. We look at what's happening to the S&P or the FTSE or the Eurex or the Topix, etc. We have exchange traded products. We focus our technical analysis on ETFs when we're working with those as well. So these are the areas that we focus technical analysis on. It's not saying that these are the only tradable instruments. We trade lots of options. There's lots of options that can be traded on stocks. We just don't focus the analysis on there. And again, that's interesting. I mean, I guess if there was a really liquid option and we're in a really sideways market where there was very little movement, well, maybe doing analysis on the option price would have some merit, but it's not what we typically do. With that, I would say that we should be remembering that, making sure that you remember where we as technical analysts focus our time. I haven't seen questions like this before, but this is new material. So I can imagine that there would be a question like, which of these areas do we not focus technical analysis on when we're analysing stocks? And it may have cash, index, ETP and options. And you'd have to obviously tick options was the one that we didn't. We'll create some practice exam questions along these lines as well. All right, so data handling. Now, data vendors, as I said, like us, we have to filter data. It's always the case that we get bad data. And so we have, I know in Optuma, we have algorithms whenever we receive data from our upstream providers, we're always filtering it and looking for anything which is just out of the norm. Anything more than 4 or 5 ATRs, gets flagged and then is up for analysis. Where that becomes really hard is that there are so many, I think in our database we've got nearly 30-odd thousand data sets that we collect, and we can't manually go through and eyeball all those charts. So we rely on the algorithms to find anything which needs somebody to look at it and then fix it as quickly as we can. But I remember a case with the Japanese yen back in April, I think in 2018. There was a low put in. Our upstream provider provided us with a low which was about, I think it was 15 yen or something too low. And we didn't pick it up for months. It wasn't until a client came to us and said, hey, your data's wrong. And then we were able to pick that up. So there's always that thing. Now, why is that important? As a technical analyst, you've got to understand that there are times where you've just got to double check your data. Especially major turning points, if you're working off those as support and resistance levels, or you're working off them for calculating retracements, things like that, you've got to double check them. Because as much as we obviously want to try and have the perfect data set, as does everybody else, that we're just all prone to these errors. Back in the olden days, obviously you can see this picture here, they would write the prices up on the board. I think when I started in the 90s writing the forerunner to Optuma Market Analyst, we used to bring in live data, and then they used to have people keying in the trades around the floor. So all the trading would be happening on the floor. There were clerks around there just keying in the numbers. And often they're typing so fast that they'd miss a number. And sometimes it was obvious, instead of 2,100, it was 210. Or it would be just a small difference at the end. But bad ticks was something that we had a lot. Fortunately, I think it's actually a much less of a problem today, still something that we have to be aware of. And hopefully whoever you're using is able to fix it as quickly as possible if something happens. But as I said, it's the high and the low which is the most important. So do make sure that you're aware of that. Late trades are always an interesting one. They're out of market trades. Typically this happens because there's so much volume coming in, or they're with brokers and they're not fully reported straight away. And so 4 o'clock comes around, the market closes, but then we still get these trades coming in. And they're just being reported. It's not that they actually executed back then, they were just being reported out of the market. So how that gets handled, we've sort of seen so many different schools of thought. We have clients that come to us and say, that's got to be in the bar, I have to have that, when they're using real-time feeds into Optuma. And then others say, no, 4 o'clock, that's it. I don't want all of that messy data mixing it up. So we give people the option to choose, but there's no real hard and fast rule of what is the right way to do it. It's really up to the individual and whether that's important to them or not. We always go by the premise that whatever's in that day, whatever trading happened that day, needs to be included in that bar. And that's why there's usually like a half-hour to 45-minute delay between the end of the market and then the reporting of the data for that day, because we're just waiting for all of those out-of-market trades to come in. So if trading intraday, so this is an example out of the text, if you were trading intraday and a bar came in or a tick came in, a trade happened right at 12 o'clock. Well, does that go into the 12 o'clock bar or does it go into the 11 o'clock bar? That's a question that the text put out there. For me, I'd say, well, that's easy. It's the 12 o'clock bar because it's the way that I've always written software is from 12 o'clock through to 12:59 and 59 seconds and 999 milliseconds. That's the 1 hour bar, and any trades that happen in that time go into that bar. So I don't think that's an issue. I put it in here because the CMT obviously thinks it is and wrote it in the text. And so just be aware of that as one of the data issues that you need to watch out for. All right, so what we're going to do is just go straight into equities on this one. So, the learning objectives with this, we want to define equities, securities, and the primary data types. We're going to look at describing the benefits of equities for investors and identify the effect of corporate actions and what that does to data and more particularly what that does to our technical analysis. Classify sectors, capitalization, and other ways to segment the market. So obviously running in, companies need to raise funds to expand. And so what we do is either we go and we create debt and try and get a loan. And if you've got really good financials, that's usually a good way to do it. You can go to the bank or you can go and issue bonds, especially the bigger companies obviously will issue bonds. The other way is obviously selling equity in the company and bringing in shareholders, because then the obligations to pay them back obviously don't exist, but then they get a share of the company as it grows and becomes successful. So equity is part or full ownership in a company. Debt represents the promise of a borrower to pay a lender, usually scheduled with interest and principal. Both have claims in the event of liquidation. However, debt has claim first. So if a liquidation event occurs, the first people to get paid are the bondholders. And so usually the government, actually, if there's outstanding taxes, they get paid first, then the bondholders, then the shareholders are able to divide up whatever's left. Can be traded from exchanges or over the counter. So from our perspective, it doesn't really matter. As long as the prices are being reported from a technical analyst perspective, we just create the analysis of the charts that we're given. So long as we have price and volume, 99% of all indicators that we work with use those two, and mainly price. I would say out of that, 80% out of price and only 20% use volume. So why buy stocks? 3 reasons that people are buying stocks. Capital gains, that's pretty easy. Income, companies which, so obviously the dividend stream. So we're looking at this saying, I want to get an income stream. That company's paying great dividends. So, that's why I want to buy the shares and enjoy that income stream. Some companies don't pay dividends. I know for a long time Apple didn't pay dividends. But what happened is all those profits go then back into the expansion of the company. Or it goes into the assets of the company, even cash holdings, which increases the value of that company anyway. So while the dividend flow may not be there, the capital growth will be there regardless. Input into management of the company. So especially if you've got enough stock, then you can actually have a say in the election of directors and special general meetings, extraordinary general meetings, that type of thing. Stockholders are able to have a vote in those events. Companies may also issue special dividend payments. So they're a little bit different. They're kind of like a discretionary one-off. There's been a huge profit. And then for taxation reasons as well, the company says, let's pay out a dividend to all the shareholders at this time. And sometimes they get reinvested back into a greater shareholding rather than cash. So there's a lot of different ways that these payouts can happen. But the three main reasons, capital gains, income, and voting, the ability to vote into the company. They're the things we have to remember. Warrants are a special type of option. The best way to think of a warrant, I know we haven't covered options yet, but we'll get there. They're issued with the stock. So essentially, like an option is the right to buy some shares or some futures, whatever. It's the right to buy without the obligation. The thing is that it's a seller, it's a third-party seller that sells the option to the buyer. In the case of a warrant, it is the company themselves that are selling the warrant to a buyer. There's no third party there doing the selling. So the company is, again, raising money, they're selling the warrant, and so the warrant buyer is paying for that warrant, and it is the obligation, the right without the obligation to take so many shares at a fixed price. And then the buyer of that option or of that warrant can decide, do I want to do that or not? It's up to them whether they exercise that or not. Typically it's issued with stock. And so it gives, sometimes when you buy stock, you can get a warrant with stock, especially when companies are in their early stages and you may not want to invest fully. They may do that to try and entice people to buy their stock. So it's at a fixed price directly from the company by a certain date. Again, exactly like an option, except sold by the company. It's the best way to think about it. Options are written by the traders, warrants are issued by companies. When a warrant is exercised, the company doesn't just hand out stock from its own pool of stock. Well, it kind of does. It actually creates more stock. So every other stockholder's holding is slightly diluted as the warrant is being paid out. Preferred stock. So it's a hybrid of common stock and bonds. Again, it's a great way for a company who is trying to raise money, wants to structure it as debt, but not give away voting right shares and things like that. So it's kind of in between corporate bonds and shareholding. And so again, from a liquidation perspective, bondholders get paid first, preferred stock gets paid next, and then common stock gets paid after that. So pay a predetermined and higher dividend at fixed intervals. So it's basically saying, come and invest $100,000 with us. We will pay you every 6 months 5% of what you invest, or whatever the number is. And then at the end of 5 years, we'll pay back your principal, is the way that works. And so it's a preferred stock. They have capital gains potential, but do not carry voting rights. Companies use preferred stocks as it gives the company the ability to raise large sums of money quickly. There are different tax treatments for it. I know it all depends on which jurisdiction you're in, but tax is treated quite different. I know in Australia it's different, in the US it's different when it comes to preferred stock. Seen as safer than common stock, again, because of the liquidation hierarchy and can be converted to common stock as well. So they can be convertible to stock. Downside is that they're also callable. Now what that means is the company may be 2 years in, suddenly flush with cash and say, all right, we don't want to have these preferred stocks out there anymore. There's no point paying these dividends to those people. We're going to call all that stock back. And they obviously will pay it out and pay back your principal, but you won't get that income stream and you have to find a different investment again. So, but again, the risks are fairly small. All right, corporate bonds, like governments, companies raise funds in the primary markets by selling corporate versions of bills and bonds. So it's a company just saying, here is a bond, buy that bond and we'll pay you interest and then we'll return the principal to you at the end. The buyer has no voting rights and no ownership in the company. Bonds are paid first in liquidation events, as already said, often used by startups and converted to common stock. So from an investor's perspective, if you think that a company may do okay, but may not actually achieve all that they're thinking that they will, their vision won't come to pass, then what you can do is say, well, look, I'll buy bonds instead. So I'm giving you a loan and you pay it back. And that way, if they're really successful, well, that's okay. You've minimized your risk. But if they're not successful, then at least you get your money back. So what does a technician need? As I said before, the most important things we always need with anything like this is price and volume. Majority of indicators are built from that. Depending on the time horizon, traders are also interested in the bid and ask. The 52-week high and low, there's obviously used for a lot of indicators. And then market capitalization, which is really the shares outstanding. I think the shares outstanding is probably the next most important piece of data. Obviously in futures, we call that open interest, but it's the same principle. So market cap there is a very important number that we work with as well. I think if you were to remember what are the things that a technical analyst needs, price, then volume, then shares outstanding, 52-week high and lows, and bid and ask. I think that would be like a hierarchy of how to remember them. So corporate actions, we have ex-dividend dates, really important to watch. So as a company comes along, there's a date at which any shareholder who has share ownership before that date, they will be paid a dividend. But anybody who comes in after that date, well, they're not going to get paid a dividend. So what we see is as the ex-dividend date is approaching, there's the price is getting pushed up because more and more people want to get hold of that dividend. And then as the dividend, ex-dividend date passes, then they hop off. So we see this rise happening quite often in a stock as it approaches the ex-dividend date. And because even if you sell the stock after the ex-dividend date, you will still be getting paid the dividends. So that's why we have that. It's an action to be aware of. We have to be aware of that as they come through. Secondary offering as well. So obviously we have the IPO, which lists the company onto the market. Sometimes we can be part of that, etc. But then as companies go to raise more money, they sell more shares. And so, again, we see price behavior, price changes happening that it actually dilutes the shareholding of all existing shareholders. So if existing shareholders know that a secondary offer is about to happen, they may try and get out and minimize their shareholding as quickly as possible and then buy back in once it's all been diluted. So again, but it's not so clear. It's not as easy to say, it's like ex-dividend where it's up and then down. There is a lot of things moving and a lot of people know earlier than other people and moving shares and things like that. So it's really a pretty hard area to identify on a chart and take advantage of. But nevertheless, that is something to watch out for. Prices typically fall into a secondary offering. Restricted shares, so you have insiders. Insiders are directors, key staff, those people who know the vision of the company and know what products it's building, what relationships it's working on. They're people who can actually obviously benefit greatly from trading in the market on their own company. Typically, especially when a company goes through an initial public offering, their shareholding is restricted, and so they're locked up. So for the first year and a half, 2 years, it sort of depends on the actual time frame, but their shares are restricted, they can't sell them. And so what happens is when that lockup period ends, then there can be a flood of key employees, directors, etc., that actually want to cash out. We've talked about that before. We touch on it again in CMT2. There's a number of reasons why insiders sell their shares. Maybe they're sending a kid to college, maybe they're doing a renovation, or they want to go on a vacation or something like that. So it's never necessarily a scary sign when insiders are selling. When they're buying, we want to pay attention to that, because when insiders buy, they know something and they're trying to get in while the stock's cheap. They cannot sell their shares during the lockup period. Prices may fall when lockup period ends as insiders cash in. All right, splits. So companies split the number of shares for a variety of reasons. Sometimes it's to keep the price more accessible to traders. Sometimes it's to stay on the exchange. When we do a reverse split, maybe the price is getting so low that they don't meet the criteria of being on the exchange, and so they do a reverse split, minimize the number of shares that are out there, and increase the price. The things with splits and reverse splits is it doesn't change the market cap or the value of anybody's holdings. So if you're holding 100 shares and it's at $100 and it goes through a split, well, you'll have 200 shares at $50. And then reverse split obviously does the opposite way. But the value doesn't change. Splits, though, are a huge issue. While all those other issues, corporate actions we talked about, we just need to be aware of them. They're just going to push price around and do things like that. Splits is a big issue. Now, particularly if you're doing trend line analysis and you had your trend lines going up and prices were up at 100 and then suddenly prices are down here at 50. We've struggled with that at Optuma for a long time. It's been, okay, do we move? Do we recalculate everything based on the split? And we worked with that for a while. The risk has always been that, okay, anytime we manipulate someone's analysis, that we get it wrong. And that's what we find really scary. So it's an area. Now, again, if you're using more indicator-based, RSIs, stochastics, those things don't change. So there's no problem with those. It's only when you're dealing with indicators that you actually place on the tool, trend lines, Fibonacci retracements, that type of thing. So again, just have to be aware of that. Reverse splits we talked about. So market segments. Most analysts measure the market by looking at indexes and groups of stocks. And so we got the index level, the stocks. GICS is a big one. There's the ICB as well, more based out of Europe, but that's probably not as popular as GICS is. I think the GICS sectors are probably the biggest type of grouping that most people follow. But then we can also group on geography, what countries, what regions, those sorts of things as well. We'll talk more about that in the indexes section as well. But sectors and industry. So these are groupings, and then we look at that group together because it can be hard to monitor all stocks. But if we group technology together, and we look at what's happening to those, we get an idea, and then we may have some feelings about, okay, when technology is going down, well, the best exposure to technology may be Apple, or it may be Amazon, or whoever. So, we can be a little more selective based on what we're seeing. Price action of groups are usually averaged using one of the index calculations, which we'll talk about. All right, so that's the equity section and the introduction to all of this. So defining the equities, securities and primary data types, we've looked at that. Describing the benefits of equities, those three key things, the income, the capital gains and the voting rights. The effect of corporate actions. What do those corporate actions, what does ex-dividend do to price? What does the end of the lockup period do? The restricted shares. Also looking at splits and how all of that works. The learning objective here on classifying sectors and capitalisation, etc., on market cap, and other ways to segment, I think that's really, we'll talk more about that in the next video on indexes. All right, thank you.